Hi everyone, I'm Drishti here along with my group members Renya, Karan, and Meena to discuss over the case. So, what is accounting profit? Accounting profit is the difference between a company's total revenue and its explicit costs and expenses, including both explicit operating costs and non-operating costs, such as the interest, expenses, and taxes. Accounting profit shows the amount of money left over after deducting the explicit costs of running the business. Here, explicit costs include labor, inventory needed for production, and raw materials, together with the transportation, production, and sales and marketing costs. What is taxable profit? Taxable profit is the income of business or individual required to pay taxes to the government. It represents the portion of total income that is subject to taxation after accounting for allowable deduction, exemptions, and credits as per the tax laws of a particular jurisdiction. Taxable profit is a crucial concept for both the businesses and individuals, as it determines the amount of tax liability owed to the government. So how is accounting profit different from taxable profit? Accounting profit is based on accrual method of accounting, which recognizes revenue when it is earned and expenses when they are incurred, regardless of when cash actually changes hands. This can result in timing differences between accounting and taxation. Taxable profit typically is calculated using the cash method in combination of cash and accrual methods, depending on tax regulations. This means that income and expenses are recognized when they are received or paid. Revenue and expenses. Accounting profit includes all revenues and expenses, whether or not they're tax deductible. It may include non-operating items like interest income and non-deductible expenses. Taxable profit. Taxable profit considers only those revenues and expenses that are eligible for tax treatment according to the tax laws. Certain income items may be tax exempt, and specific deductions or tax credits may be allowed, leading to various variations from accounting profit. Depreciation and amortization. As per accounting profit, depreciation and amortization are recorded based on accounting standards, which may differ from the tax laws. This can result in variation in the timings and amount of depreciation and amortization expenses between accounting and tax calculation. Taxable profit. Here, tax regulations often have specific rules for depreciation or amortization of assets, such as accelerated depreciation methods or limitations on the types of assets that can be depreciated. These rules can lead to the difference of taxable profit, provisions, and reserve. Accounting profit may require companies to create provisions or reserves for expected future expenses, which can affect the accounting profit, but may not have a corresponding impact on taxable profit until the expenses are deductible for tax purposes. Reporting purpose. Accounting profit is primarily used for financial reporting to stakeholders, such as shareholders, investors, or creditors, and it does not consider the tax implications. Whereas taxable profit is used for calculating income tax liabilities and complying with the tax laws. It is the basis for determining how much tax a company owes to the government. Accounting profit only considers the current financial year, whereas taxable profit considers the previous income as well. Accounting profit recognizes business profitability, whereas taxable profit determines tax liabilities of the business. Both the accounting profit and taxable profit are correct in their place. Accounting profit is calculated as per the accounting principles and assumptions, while taxable profit is calculated as per the prescribed tax rules of every country. Both the profits are calculated for a specific period. Many times, accounting profit is greater than taxable profit. So neither accounting profit or taxable profit is inherently better than one another. They serve different purposes and are used in distinct contexts. A business or individual should use both measures appropriately to meet their financial reporting and tax compliance needs. Consulting with the accounting and tax professionals can help ensure both accounting and tax considerations are addressed effectively. Thank you.
Hello, my name is Renia, and I am here today to talk about the difference between income tax expense and income tax payable. This topic is important because it can help investor understand how the companies are managing their tax liabilities. So, generally speaking, income tax expenses are the total amount of taxes owed by an individual or other entity to our taxing authorities, whereas uh, income tax payable is a liability reported for financial accounting purposes that indicates the amount that an organization expects to pay an income taxes within 12 months. So talking about our case study, which is our income tax expenses and income tax payable be the same at the end of accounting period. In my opinion, the income tax expenses and income tax payable are not necessarily the same. The main reason for this are deferred taxes, time variation, tax credit, change in tax law estimates, and so on. So talking about change in time variation, income tax expense is recognized on accrual basis, whereas income tax payable is recognized on cash basis. This leads to the difference in timing when income tax expenses are recognized and when tax payable is recognized. The variation between how an item is treated for tax purposes and how it is treated for accounting purposes in financial reporting differs the income tax expense and income tax payable at the end of accounting period. So the next reason for this are the deferred taxes. Deferred taxes are the accounting adjustment that are made to the account for the timing differences between the recognition of income and expenses for accounting purposes and the recognition of income and expenses for tax purposes. For example, if a company expenses the cost of new assets for accounting purposes over a period of time, but the company is able to deduct the entire cost of the assets for tax purposes in the year of purchase, this creates deferred tax liability. Another reason why income tax expenses and income tax payable may not be the same is the companies may be able to claim the tax credit or other deduction that are not reflected in their accounting periods. For example, a company may be able to claim a tax credit for research and development expenses. This will reduce the company income tax payable, but it will not reduce its tax income tax expenses. As a result of these factors, it is common for income tax expenses to be higher or lower than income tax payable. This is why it is important to distinguish between the two concepts. Overall, it is important to understand the difference between income tax expenses and income tax payable, because aside from the above mentioned points, there may be other causes for the difference in income tax and income tax expense and income tax payable, which may be change or modification in tax law estimation and so on. The differences can be significant, and it is important to be aware of when interpreting a company's financial statements. So these are the references that I used for my case study. Thank you.
Hi, my name is Meena, and my topic is why profitable company doesn't have any income tax payable to relevant authority. So profitable company is a company which generates more revenues than the expenses they spend on their operations. In terms of profitable company, profitability is considered one of the indicator to measure the financial performance of the company, and can also be measured by some financial ratios such as return on investment, return on equity, and earning per share. And the next topic is reasons why profitable company not have an income tax payable. So the first reason is tax incentives and tax exemptions. So tax incentives are those incentives that the Australian government will offer those companies which invest in research and development or create job opportunities or create innovation in order to promote specific behaviors, activities, and industries. And the second one is utilization of tax losses carried forward. So this one is if a company is experiencing losses in their previous years, they are allowed to carry those losses forward in the future years, so that it helps them to reduce some temporary losses, and can also be not pay any taxable income in the current year. And the third one is timing differences. Timing differences is also one of the reasons why financial accounting differs from the tax accounting. It's because of the different rules and principles governing of income and expenses under financial accounting standards such as GAAP and IFRS. And the last one is tax planning strategies. Tax planning strategies are those strategies that the companies applies to legally reduce their tax liabilities or reduce their taxable income. So this one is the company to get the benefit from tax credit, and also they helps them to level out some tax liabilities from the current year. And the next topic is potential for tax related assets in financial statements. So there is some certain of recognition of tax related assets in financial statements, but it does not directly lead to the recognition in the financial statements. This can create a deferred tax assets which may be eventually be recognized in the financial statement of the company, whereas the potential of tax related assets are recognized. And Next topic is tax. First one is tax loss carried forward. As I mentioned earlier, the tax loss carried forward are those tax losses that the company experienced in their previous years to carry forward in the current year, so that they can offset taxable income in the future years. And the second one is deferred tax assets. So deferred tax asset is only recognized when there is no chance of tax loss carried forward to be realized in the future years. This one is done when there's the two tax loss carried forward and deferred tax assets at the same time. Thank you.
Valuation allowance is a contra account to deferred tax assets. It is established when it's more likely than not that some or all of the deferred tax assets will not be realized in the future. In other words, if there is doubt about the ability to generate future taxable income to utilize the tax loss carry forward, a valuation allowance is used to offset the deferred tax asset. Income and expense timing differences. In accounting, income and expenses are recognized based on different accounting methods, whether accrual basis or cash basis, compared to how they are recognized for tax purposes. These differences lead to temporary differences in taxable income and financial statement income, which can result in deferred tax assets or liabilities. So, incurring a tax loss does not automatically lead to the recognition of a tax-related asset. The reason is that the recognition of a deferred tax asset related to tax losses depends upon whether it is more likely than not that the company will generate future taxable income against which the tax losses can be utilized. Hi, myself Karanpreet Singh. My student ID is 2023001101. My unit code is TACC605, Corporate Accounting. Ladies and gentlemen, today I want to talk to you about a crucial aspect of business finance in Australia, which is income tax and how companies should respond when the tax rate changes. It's a topic that might sound a bit technical, but I'll do my best to break it down in simple terms. In Australia, just like in many other countries, companies are required to pay a portion of their earnings to the government as income tax. Tax is a major source of revenue for the government, as it is also legal obligation for companies in Australia. During these scenarios, it is often identified that the tax rate alterations can happen, which is due to the decisions taken by government for redistribution of wealth and budget allocations. This is important because it helps fund public services like schools, hospitals, and infrastructure. But here's the thing. The amount a company actually pays in income tax is often different from what they report as income tax expense in their financial statements. So what happens when the tax rate changes and why is it important for companies to take action? When the government decides to change the tax rate, it means that the percentage of a company's profit they have to pay as a tax may go up or down. First point is financial reporting. Companies are required to prepare financial statements, including the statement of profit and loss, showing how much money they have earned and spent. When the tax rate changes, the amount a company set aside for taxes also changes, affecting their reported profits. Second is investors' confidence. Investors, whether they are individuals or other businesses, rely on financial statements to make decisions about investing in a company. A change in tax rate can affect a company's bottom line, which in turn can influence investors' confidence and their informed decisions. Compliance. Companies must follow tax laws and regulations. When the tax rate changes, they need to ensure that their tax calculations and payments are accurate and compliant with the new rules. Failing to do so can result in penalties and legal troubles. So what action should be taken when a tax rate changes? First is update financial statements. Companies should adjust their financial statements to reflect the new tax rate. This means accurately calculating and reporting their income tax expenses in line with the current laws. Communication. Companies should communicate with their stakeholders, investors, and other stakeholders about the impact of the tax rate change on their finances, as transparency is the key to maintain the trust. Adaptation. This may involve seeking advice from tax professionals to ensure that they are taking advantage of any available reductions or credits as per their tax planning strategies. In summary, when the tax rate changes in Australia, it's not just a simple matter of plugging in a new number on the tax return. It has wide-ranging implications for a company's financial reporting, investor relations, and overall financial health. Taking proactive and transparent action is essential to navigate these changes successfully. By doing so, companies can continue to thrive while fulfilling their tax obligations to support the broader community. Thank you for listening.